We are active in both the collateral space, where we mobilize assets on the part for our FCM clients and help them source securities at their various custodial locations, do some optimization work and move that towards CCPs to satisfy their margin obligations. So we've added a number of additional CCPs and collateral locations this year. So in terms of CCPs, we cover about 85% of daily IM that moves in terms of our coverage of CCPs, which is a very significant footprint, bringing very significant transparency to our clients. And then also have expanded our reach in terms of custodial and CSD locations as well. So that's allowed us to really make some very good progress on the client front, and we continue to make very, very good progress there. On the FX side, you saw last year that we announced that we're providing PVP settlement, or payment versus payment settlement, or riskless settlement for Wells Fargo and HSBC. That was very much in the public domain last year. We'll soon be making some pretty important announcements about an extension of our reach. I can't really sort of let the cat out of the bag right now, but in a week or so that will be news. But if anything, I think that what we've learned from the latest triennial survey that was published by the BIS, that volumes have increased. Currencies that are not eligible for CLS settlement have become even more important to daily liquidity for most of the large players in the market. And our solution allows our users to essentially take advantage of the ability to settle on a riskless basis outside of that CLS environment. It's just created a lot more volume coming through the pipes, particularly in the cleared derivative space. And for us, that's been a very good thing, because it continues to shine a very bright light on ways to, on the one hand, reduce overall settlement risk, or increase the speed at which you can essentially have the certainty that your collateral is moving where it needs to get to. And so those are the types of solutions that we bring. So if anything, the enhanced volatility, the sustained volatility that we've seen in markets, the overall increase in interest rates, the kind of the meltdown we saw in the UK on the back of the last government in the gilt market, all has brought us, it's just increased client focus on the value that we can bring in terms of the transparency, the mobilization assets, and the speed with which we can actually move those assets on behalf of our client. I think one of the toughest things that we need to do is not so much from a technology point of view, or from a product point of view, it's from a mindset point of view. And this has been a major theme in some of the panels upstairs here at the FIA conference. People tend to sort of revert to the mean, which is the way we've been doing things for the past 20 or 30 years. And so really getting people to change their mindsets into a real sort of innovator's mindset, that there are new technologies that allow actors to do things in a different way, more efficiently, with less exposure, with better risk management, ideally with lower costs, both in terms of funding and liquidity. Even if all those things make sense, it's hard to get people to sort of shift the mindset, well, it ain't broke, so I don't need to fix it, to yes, this helps me advance my business model. How can I sort of secure the funding to get done what we need to get done? I think one of the more disturbing things that we've seen from the regulatory point of view is, for instance, in the discussion around the use of blockchain and distributed ledger technology for crypto assets, the suggestion or the proposal that a 2.5% tax be applied to distributed ledger technologies and blockchains that are used to essentially settle or vehiculate crypto assets, which we think is a tax on innovation, and very not a good thing for anyone, really.